Hi, welcome to my channel. Banking is a system of financial services that allows individuals, businesses, and other organizations to manage their money and credit. At its core, banking involves two primary functions: the management of money and the extension of credit. Money management involves depositing funds into a bank account and using various banking services to manage those funds. For example, individuals may use checking accounts to pay bills and make purchases, while businesses may use merchant services to accept payments from customers. Banks also offer savings accounts and other investment vehicles that allow individuals and businesses to earn interest on their deposits. Credit extension involves the lending of money to individuals and organizations. Banks provide loans and credit to borrowers for a variety of purposes, such as purchasing a home or car, starting a business, or covering short-term expenses. Banks make money by charging interest on these loans and other fees, such as origination fees and late payment fees. To manage money and extend credit, banks rely on a variety of financial tools and services. These include credit analysis and risk management, investment banking, trading and sales, and asset management. Banks also engage in a range of other financial activities, such as underwriting and issuing securities, providing financial advisory services, and conducting mergers and acquisitions. Overall, banking plays a critical role in the global economy by providing individuals and businesses with the financial tools they need to manage their money and credit. Banks are also important intermediaries between borrowers and investors, helping to allocate capital efficiently and promote economic growth. Money and credit are two important concepts in banking that are closely related. Money refers to any medium of exchange that is widely accepted in transactions, such as currency, coins, and bank deposits. Credit, on the other hand, refers to the ability to borrow money or obtain goods or services now with the promise to pay for them later. In the context of banking, banks play a critical role in creating and managing both money and credit. Banks are able to create money by lending funds that they have on deposit from customers. When a bank issues a loan, it creates a new deposit in the borrower's account, which can then be used to make purchases or pay bills. This process is known as fractional reserve banking, where a bank is required to keep only a fraction of its deposits as reserves and can lend out the remaining funds. In addition to creating money, banks also play a critical role in providing credit to individuals and businesses. Banks provide loans and credit lines to customers, which can be used to finance everything from home purchases to business expansion. Banks earn interest on these loans, which helps to fund their operations and generate profits. Banks also help to facilitate credit by providing payment services such as credit cards and electronic payment systems. These payment services allow customers to make purchases and pay bills without having to use cash, which can help to increase the availability of credit in the economy. Overall, money and credit are two key components of banking, with banks playing a critical role in creating and managing both. By providing access to credit and creating new money through the lending process, banks help to facilitate economic growth and activity. Banking is a system of financial institutions that provides a range of financial services to individuals, businesses, and governments. The two most important functions of banks are managing money and providing credit. Managing money. Banks accept deposits from customers, which they hold in various accounts such as savings accounts and checking accounts. These deposits are then used to fund loans and other investments. Banks also offer a range of other financial services, such as foreign exchange, investment management, and insurance. Providing credit. Banks are also responsible for providing credit to customers in the form of loans and other credit products. Banks use the deposits they hold to make loans to borrowers, such as individuals and businesses, who need access to capital. Banks also provide credit through credit cards, overdrafts, and other forms of credit. When banks provide credit, they charge interest and other fees to generate revenue. The interest rate charged on loans depends on a variety of factors, including the creditworthiness of the borrower, the size and term of the loan, and the prevailing market interest rates. Banks also use credit scoring models to assess the creditworthiness of borrowers and determine their ability to repay loans. Banks also play an important role in the broader economy by facilitating the flow of money and credit between savers and borrowers. They help to allocate capital efficiently and ensure that savings are put to productive use. However, banking is also subject to risks, such as credit risk, market risk, and operational risk, which banks must manage carefully to ensure their financial stability and the safety of their customers' deposits. Money and credit are two essential concepts in banking. Money refers to any medium of exchange that can be used to purchase goods and services, such as cash, checks, or electronic payments. Banks play a critical role in managing the money supply by issuing and managing currency, holding deposits from customers, and lending money to individuals and businesses. Credit, on the other hand, refers to the ability to borrow money, typically with the promise to repay it later with interest. Banks are major providers of credit, offering a range of loan products such as mortgages, personal loans, and business loans. When a bank lends money, it creates credit by extending an asset, the loan, to the borrower while simultaneously creating a liability, the deposit or funds transferred to the borrower's account. This process of creating credit is called fractional reserve banking, as banks typically hold only a fraction of the funds they lend out as reserves. Banks also play a crucial role in the creation of money through the process of money creation or the multiplier effect. When a bank lends money, it creates new money in the form of credit, as the borrower can spend the loaned funds, which will then be deposited into another account, which can be lent out by the bank again. This process can lead to the creation of multiple times the original amount of credit created by the bank, as long as the funds continue to circulate through the banking system. In summary, money and credit are two fundamental concepts in banking. Banks play a critical role in managing the money supply and creating credit through the issuance of loans. The process of fractional reserve banking and the multiplier effect of money creation are crucial to understanding how banks operate and their role in the economy. Money and credit are two important concepts in banking that are closely related. In simple terms, money refers to the physical currency or digital currency that people use to make purchases and transactions, while credit refers to the borrowing of money or the ability to buy goods or services with a promise to pay back the money at a later time. Banks play a crucial role in the creation and management of both money and credit. Here's how it works. Money creation. Banks are responsible for creating most of the money in circulation. When a bank issues a loan, it essentially creates new money by crediting the borrower's account with the loan amount. This new money can then be used by the borrower to make purchases or pay off debts, thus increasing the money supply in the economy. Deposits and withdrawals. Banks also facilitate the storage and transfer of money through deposit and withdrawal services. Customers can deposit their money into a bank account, and the bank will keep the money safe while allowing the customer to withdraw it as needed. Banks may also pay interest on deposits as a way to incentivize customers to keep their money in the bank. Credit. Banks also play a crucial role in providing credit to individuals and businesses. When a borrower takes out a loan, the bank is essentially providing them with credit that they can use to make purchases or investments. The borrower then agrees to pay back the loan amount plus interest over a set period of time. Overall, banks are essential intermediaries in the creation and management of money and credit. They provide a range of financial services that enable individuals and businesses to store, transfer, and borrow money, which in turn helps to fuel economic growth and development. Please subscribe my channel and share video.